Chapter 10 of Management, an Integrated Approach. Performance Management, Part 1. Chapter 10 Discussion. Chapter 10 Discussion questions to think about while reading this chapter. Discussion Question 1, on the value of measuring. What does it mean when a manager says, if you can't measure it, you can't manage it, why can't you manage it? Discussion Question 2, on the value of benchmarking against other companies. Why would a company benchmark its performance against companies in different industries? What value can be derived from considering these completely different business contexts? Discussion Question 3, on the value of maintaining transparency with employees. What tools can companies use to make their performance against key metrics transparent to all employees? What are the advantages of being transparent? Key topics covered in this chapter are: Topic 1. Performance management encompasses the tools and processes that managers use to ensure a company is meeting its strategic objectives. The control cycle provides one way to measure and assess the performance of a company. The control cycle encompasses 4 key activities. 1. Identifying key measures of analysis. 2. Setting performance targets. 3. Monitoring and measuring results. And 4. Taking corrective action. Topic 2. The Balanced Scorecard provides a comprehensive way to identify measures of performance. The Balanced Scorecard includes a financial perspective, a customer perspective, a business process perspective, and a learning and growth perspective. Each of these perspectives, in turn, includes key metrics that help a manager better understand the performance of the firm on a number of dimensions. Certain perspectives are more important at specific points in a firm's life cycle. Topic 3. A company sets performance targets through both external and internal mechanisms. A key external mechanism to set performance targets is to benchmark the firm's performance against competitors or other firms that are best in class in their respective industries. Internal performance targets can be derived and monitored through budgets and forecasts. Topic 4. To ensure that a firm meets its targets, a manager must monitor and measure performance. A number of tools exist, which enable a manager to assess performance, including financial management, total quality management, Six Sigma, and employee evaluations. Managers need to understand that every organization is unique, whether in size, history, culture, or industry. As a result, managers must not rely on a single method of performance management. Rather, they should consider the methods as tools to use under appropriate conditions. For example, Six Sigma is most appropriate for manufacturing processes while budgeting is most appropriate for resource allocation. Topic 5. When a firm is not meeting its targets or objectives, a manager needs to take corrective action. Corrective action can take many forms. If the issue is employee performance, a manager may need to re-examine incentives to ensure that they are aligned with desired results. If the issue is a misaligned strategy or process, the manager may need to re-evaluate the firm's goals and objectives. As a manager examines the performance of a company, he or she may also need to recalibrate the control systems that are in place. Are they measuring what needs to be measured? Are managers getting the information that they need in a timely fashion? If not, these control systems may need to be revised. Performance management systems help a manager to assess how well a firm is pursuing its strategic, financial, and operational objectives. Introduction. While an organization's strategy is usually formulated by top executives, others in the organization are responsible for its implementation. It may seem like a daunting task to take simple ideas, summarized in just a few sentences, and use them to generate activity for an entire organization. But in business, as in life, measurements are the most effective way to understand if you are accomplishing the right goals. The underlying linchpin to success is choosing the correct measurements. If done well, performance measures will support an organization's strategy by allowing managers to understand the implications of their actions and tactics. 1. To understand how performance management works, we must understand it in the context of the organization, which can be conceptualized as an engine. A car engine undergoes a complex series of actions including the orchestration of moving parts that, when timed to perfection, propel a vehicle down the road. But if you look at a car from a distance, it is simply a metal object that takes an input, gasoline, and transforms it into an end product motion. A business operates in the same way and can be broken down into 3 parts: inputs, transformation, and outputs. While businesses look simple from a macro view, they consist of complex systems that work together to transform inputs into outputs. The control cycle, a 4-stage process, see Figure 10.1, provides the mechanisms and systems that monitor the transformation process, ensuring that outputs are produced to the desired quality, quantity, and specifications of an organization and its customers. The control cycle includes 4 key activities. 1. Identifying measures that track the right information to assess the performance of the company. 2. Setting targets for the selected measures. 3. Monitoring performance against the selected measures. And 4. Taking corrective action when performance does not meet expectations. Corrective actions often influence the future measures that are identified to assess the performance of the organization. Each section of this chapter is dedicated to one of the 4 stages of the control cycle. Like most concepts described in this book, management control and performance management are not prescriptions for well-defined plans. No universal system can be applied to all organizations. Approaches will differ based on specific local and organizational cultures. Managers must be thoughtful and creative to understand their organization and use the correct tools that fit their context. As managers design control systems, it is important that they ask the following questions. Is it relevant? Does it work? How well does it work? The following case shows how Shell reevaluated and reconceptualized its strategy and used techniques of the control cycle to implement it. Creating a new strategy, sustainable development at Shell. For years, Royal Dutch Shell was proud of its financial performance and core set of business principles, which outlined a comprehensive roadmap for serving a variety of constituents. But during the mid-1990s, Shell experienced 2 major controversies that contributed to a collapsing public image. The first occurred in early 1995. Shell was going to retire one of its oil storage buoys, the Brent Spar, by sinking it in the North Atlantic Ocean. Just before executing the plan, it received significant public criticism from Greenpeace, sparking international media attention. Activist criticism turned into public protests, including the destruction of several Shell service stations in Germany. Shortly after the Brent Spar incident, Shell found itself in the middle of another public controversy. The company operated heavily in oil-rich Nigeria. At the time, a human rights activist, environmentalist, and leader of a local tribe was detained by the government and eventually executed. Because Shell continued investment and operations in the region, it was again criticized by the public and the media. These 2 incidents forced Shell to reassess its business practices, its relationship with its stakeholders, and, ultimately, its strategy. Determined to define a new strategy, Shell conducted a widespread survey of key stakeholders from around the world, including non-governmental organizations, NGOs, academics, local community leaders, and government bodies from 14 countries. Shell followed up with a survey of 7,500 people from the general public in 10 countries, 1,300 opinion leaders in 25 countries, and 600 Shell employees in 55 countries. Results showed that customers expected the company to move from a trust me attitude to a show me attitude, as stakeholders wanted to see that Shell was living up to high environmental and social standards as well as financial metrics. By 1997, a new strategy emerged. Shell created the Sustainability Development Group, SDG, which was focused on attaining sustainability and delivering 3 components to the company: an annual Shell report that described economic, social, and environmental performance, the Sustainable Development Management Framework, SDMF, which promoted sustainability practices and described how to implement the SDMF in business units worldwide, and the definition of Key Performance Indicators, KPI, to monitor performance. Shell's 1998 annual report provided information on sustainability initiatives to key stakeholders, and it was sent to shareholders, NGOs, academics, governments, employees, and the socially responsible investment community. The 1998 report restructured the content to focus on the 3 pillars of its sustainable development strategy: financial, environmental, and social performance. It also included a 5-year strategy for certain targets and explained how the company would achieve those targets. As the years went by, Shell improved its measures and processes. By 2001, Shell gathered reliable data from all of its core businesses in all parts of the world and verified it with third-party organizations. The annual report was the most important instrument for transparency between Shell and its stakeholders. The SDMF was a tool used to introduce strategy objectives to all business units. Senior managers created manuals with an interactive guide to implement the framework and sent SDG employees as consultants, promoting communication between managers and higher-level strategists. But upper-level management understood that it could not push the framework from the top and introduced the SDMF to each of its 3,500 managers worldwide, allowing them to use their own methods to incorporate it into their businesses. By giving each manager the autonomy to adapt and implement the framework, each manager was allowed to balance all of his or her resources to achieve strategic objectives, to facilitate adoption across businesses. Senior executives encouraged managers to share best practices. The KP served as a platform to set targets, measure performance, and drive continuous improvement. Focused on strategic success, the KP were quantitative and qualitative measurements that balanced short-term goals with long-term needs and were critically important to both internal priorities and external concerns. 11 After an iterative process of narrowing down KP, Shell created a set of 16 KP, 11 of which were complete of new measurements for the company. 12 While Shell continued to measure return on capital, total shareholder return, and greenhouse gas emissions, it introduced new KP such as reputation, social and environmental performance, and integrity to address its new strategic direction. When all was said and done, senior managers at Shell had successfully undertaken one of the largest initiatives by a major energy company to balance financial, environmental, and social performance, incorporate it into its strategy, implement the strategy throughout the company, and track the implementation with a comprehensive performance management system. Case in point: creating a new strategy, sustainable development at Shell. 1. Why did the Brent Spar incident redefine Shell's strategy? 2. What stakeholders did Shell engage with to redefine its strategy? 3. How did the process of redefining Shell's strategy link to performance management? 4. How does Shell monitor and communicate the attainment of performance objectives? Identifying measures. Shell identified several KP that, when implemented correctly, helped the organization become the first in the industry to succeed in incorporating environmental and social aspects into its strategy. Managers have long known that if you can't measure it, you can't manage it, and measurements serve a dual purpose. 14. Although they help managers assess past performance, they also guide future behavior. In business, only two things can be observed, measured, and monitored: behavior and outputs. While behavior refers to the actions and decisions of individual employees, outputs are the products and/or services that an organization produces. Outputs can be specified for an entire organization, such as the number of laptops manufactured by Apple, or for departments of an organization, such as the number of software updates for the iTunes division. While outputs are quantifiable and controlled from a central office, behavior is more flexible and diverse. Therefore, it is controlled and measured at the unit or department level. As such, most organizations identify both high-level corporate measures of success as well as department, function, or team measures of success. Sometimes corporate measures need to be translated into team measures. In other instances, teams have their own unique measures. For much of the 20th century, businesses relied heavily on financial numbers to measure success, such as return on investment and profit. These financial metrics are still important today, but so are other measures, for example, quality, rate of innovation, customer satisfaction, and employee engagement. More recently, executives have emphasized non-financial measures, for example, sustainability and social impact, to complement financial measures and encourage a more balanced perspective. Despite its value, measuring data such as employee attitudes or research and development (R&D) activity can be challenging. As a result, they often do not get measured, but companies are now developing meaningful metrics to assess their performance in light of their strategic goals. By far, the most popular metric is the balanced scorecard, with a reported 60% of Fortune 1000 companies experimenting with one. The balanced scorecard. The balanced scorecard was created to help businesses translate strategy into action by identifying the most critical measures to drive business success, and by linking long-term strategic goals with short-term operational actions. The primary advantage of using a balanced scorecard, however, is that it helps managers create a set of quantitative and qualitative measurements that are related and mutually reinforcing, known as cause and effect relationships. It allows companies to quickly look at failures and isolate what may be their root cause. At the same time, it also allows them to understand the source of their successes. With 25 to 30 measurements, the balanced scorecard is often a complement to the traditional measures that companies use to monitor their health. Depending on the size and scope of the company, The balanced scorecard can be used to assess the performance of the company as a whole, or it can be used to assess one business unit or division. For example, GE operates in many businesses, ranging from aircraft engines to healthcare imaging, each with a different strategy. If GE chooses to adopt the balanced scorecard, it would need to create a unique scorecard for each of its business units. A smaller company, on the other hand, may have a single strategy for the entire firm, thus needing only one balanced scorecard. Using 4 different perspectives: 1. The financial perspective, 2. The customer perspective, 3. The business process perspective, and 4. The learning and growth perspective. The balanced scorecard aligns the goals of an organization with the day-to-day action of individual employees. See Figure 10.2. Financial perspective. The financial perspective involves choosing the financial measurements that are most important for reaching strategic goals. Key financial measurements include net income, cost of goods sold, administrative expenses, inventory management, accounts receivable, return on equity, and return on assets. New financial measurements have been developed to complement conventional measures, including activity-based costing, ABC, which provides a more accurate view of the costs to develop products. ABC is the accounting system used to assess the specific cost components of producing a product or service. ABC links production to a series of activities and assigns a cost to each activity, providing a more accurate picture of how to minimize these expenses. We will review some of the most important financial measures in greater detail in the section on monitoring and measuring performance. Customer perspective. The customer perspective links key customer-based metrics, such as market share and customer retention, to the financial performance of a firm. The customer perspective of the balanced scorecard is used by managers to identify the most important customers of the business, and to measure how well the company is doing in meeting or exceeding these customers' needs. For the balanced scorecard to be valuable, measurements from the customer perspective must link directly to financial results or strategic goals. While the list included in Table 10.1 is not exhaustive, it covers the most important customer-based measurements. In addition to the general customer metrics, firms should also understand customer value propositions, which drive many of the outcomes described in Table 10.1. Value propositions refer to the quantitative or qualitative aspects of products or services that customers value most. Each major customer segment will value different things, and it is up to the company to determine those core drivers of success. Companies should try to understand what customers most value, and how well they are delivering that value. Sometimes the implications of making specific marketing and operational choices are clear. For instance, it didn't take long for the management at Coca-Cola to learn that the introduction of New Coke was based on an imperfect understanding of consumer preferences. For nearly a century, Coca-Cola was not just the market leader of soft drinks, it was an American icon. The original formula for Coca-Cola, conceived in the 19th century, was the backbone of its worldwide reputation, and company leaders vowed never to change it, regardless of local tastes and cultures. But during the 1980s, Pepsi ran a successful marketing campaign, known as the Pepsi Challenge, that slowly chiseled away at Coca-Cola's market leadership. After Pepsi commercials showed that consumers preferred Pepsi in blind taste tests, Coca-Cola confirmed the findings with its own nationwide taste test. Believing that it was working with solid data, Coca-Cola changed its formula to mimic Pepsi with a smoother and sweeter taste. Many consumers were outraged, and the company received thousands of angry phone calls and letters. The public outrage lasted for 3 months and transcended nations and cultures. The opposition to the change was so strong that Coca-Cola brought back the old formula and renamed it Classic Coke. It took years before Coca-Cola was able to regain its status as a market leader and worldwide icon. This incident illustrates the importance of using and analyzing the right measures to make significant strategic choices, as well as the importance of drawing the right conclusions from the data. As Coca-Cola learned, organizations must excel at implementing their strategy, analyzing the business environment, and adjusting tactics when new threats or opportunities are discovered. Meanwhile, they must continuously improve their operational performance to ensure that their organizational design choices match their strategic objectives. Internal business process perspective. The business process perspective focuses on the manner in which the company runs its operations. For instance, does the manufacturing operation run smoothly? Is the company meeting product quality standards in an efficient and cost-effective way? Are customer service calls handled expeditiously? The company can't produce strong financial results or deliver value to customers if they cannot run their operations effectively and efficiently. With the balanced scorecard, managers identify the most important business processes to achieve the best results. Learning and growth perspective. The final component of the balanced scorecard, the learning and growth perspective, identifies the infrastructure and skills needed to carry out business processes, interact with customers, and achieve long-term financial growth. It also helps to identify gaps in capabilities or resources. Organizational learning and growth stem from employee measurements, information systems, and employee motivation. Managers often measure employee satisfaction, productivity, and retention to better understand employee issues or concerns. Information systems stimulate learning and growth by giving employees the necessary information to be effective and innovative. The key to this perspective is fostering an environment that is conducive to learning. Managers must make time for reflection and analysis, and train employees in brainstorming, problem-solving, and evaluating experiments. Implementing the balanced scorecard. Implementing a balanced scorecard can often require a company to change the way it operates. Because each company has a different history, culture, mission, vision, and strategy, the employees look at the balanced scorecard through a different lens. One aspect of the scorecard may be more important than another for specific businesses. For example, a company that is focused on innovation and new product introduction may heavily emphasize the learning and growth perspective. A different company that is in an entrenched, highly competitive market for commodities may emphasize the business process perspective to drive production efficiency. The following case study illustrates how one company has chosen to implement the balanced scorecard. The sustainability scorecard at Amanco. Water is the world's most abundant resource, and yet it is still elusive to many people in the world. As of 2005, there were still 1.1 billion people without access to drinking water and 2.6 billion who had insufficient sanitation. Water is critical for more than just human health. It also drives long-term economic development and environmental sustainability. As a result, water services presented a multi-billion-dollar global market, and the Latin American company Amanco was in the ideal position to capitalize on it. Amanco was a major producer of plastic piping and accessories for water systems throughout South America. The company worked with clients to manage the complete drinking water management cycle from extraction and distribution to collection and waste management. Although Amanco obtained the highest market share in the industry and operated on a global scale, it had to constantly improve its operations to remain competitive. While it developed new materials, production prices increased and local companies offered substitutes for its products. Amanco wanted to be known as a socially responsible company that provided economic value, ecological efficiency, and strong ethics. As a result, it adopted a triple bottom-line strategy to promote the following goals: create economic sustainability in the long run, generate value through a system of corporate social responsibility, generate value through environmental management. To achieve its goals, Amanco adopted the balanced scorecard and modified it to fit its unique company vision. The scorecard had all of the elements of a traditional balanced scorecard, including the financial, customer, business process, and learning perspectives, but it also included a fifth perspective, an environmental and social dimension. When looking at its business from a financial perspective, Amanco wanted to produce economic value and sustainable revenue. The company achieved this by increasing its sales each year and reducing operating costs. Through the customer perspective, Amanco measured customer satisfaction and product innovation. Through the business process perspective, the company focused on four main areas: branding, customer management, product innovation, and financial management. It identified multiple measurements to improve each of these processes, including measuring the communication between marketing and consumers, ensuring quality deliveries, improving creativity in R&D, and optimizing the purchase of raw materials. The fourth perspective of the balanced scorecard, learning and growth, focused on leadership development, succession planning for managers, and collaboration among employees with different competencies. Amanco's social and environmental perspective encompassed a broad definition, including employees, local communities, and the industries in which the company competed. Amanco conducted employee satisfaction surveys, measured time lost due to injury, and kept tabs on the percentage of women employed. For environmental effect, it measured per unit inputs and waste from its processes. To improve communities, it measured water savings and increased income from communities that used its products. During the first 3 years of introducing the new system, Amanco experienced success in all areas of its vision. Each year, profitability, return on net assets, and environmental efficiency improved. Despite the fact that Amanco made sacrifices for social and environmental purposes, its financial earnings still increased by 44% during the first 3 years. Setting performance targets. After using the balanced scorecard or another system to identify key measurements, the next step is to set performance targets for those measures. Setting goals and measuring their achievement is a strong motivational force in itself, which becomes more powerful when targets are meaningful and serve a greater purpose. One way that companies set performance targets is by comparing or benchmarking their performance to other companies that are considered best in class in their respective industries. Benchmarking. The concept